Hello, everyone, and welcome to another episode of the Financial Advisors Want to Know podcast. I'm Catherine Tindall, a tax partner here with Dominion Enterprise Services. We're a specialty tax and accounting firm that serves financial advisors for their practices and their planning concerns. And on today's episode, we have a very fun topic going through buy-sell agreements. It's something that I get queried a lot from clients. And on today's show, we have with us Paul Hood, Jr. He's a JD, LLM, nationally recognized estate and tax planning attorney. He's an author and speaker with decades of experience helping families and advisors navigate complex legal and financial matters. He's written over 500 professional articles and several books, including Yours, Mine, and Ours, Estate Planning for People in Blended or Step Families. And he's known for combining deep technical expertise with practical insights. So thanks so much for joining me today, Paul. I'm looking forward to this conversation.
Thank you very much, Catherine. And I'm very happy to be before your audience because I have a couple of very important messages for them and opportunities for them.
Yeah. And I think, when advisors come to us for initial tax planning work, one of the first questions, even if it's not on the top of their mind, something that very quickly comes up is, okay, what do you have in place for succession planning right now? Like, do you have a buy-sell agreement? Like, if something were to happen to you, what happens next? And for a lot of them, because it's not seen as an immediate need, it's not something that's usually kept up to date, or it's something I'll get to it kind of bucket list item. But I've seen some disasters, and I'm sure you've seen some too. So when it comes to getting some structural pieces in place for those agreements and things that you've seen go well and go poorly, where's the place you usually like to recommend people start, or how to frame that conversation?
Well, I will tell you that because I wrote a book about buy-sell agreements that's been very, very favorably received, I see buy-sell agreements from all around the country. And now it's a biased sample because they won't send me an agreement that they think is okay. Because it's coming to me means they've got some question about it. But about 90% of those that are sent to me are defective in some form. And I have a graphic called the Bad Buy-Sell Agreement Circle of Life. And at the top is buy-sell agreement is signed. Now, you know what happens when those things are signed, don't you? They get folded up neatly. They go into the upper right-hand drawer. They make its way back to the back of said drawer where they now hang out with a couple of packets of plastic silverware, some Taco Bell special sauce, and a couple of dead lottery or raffle tickets until a triggering event happens. They then pull the buy-sell agreement out, read it, and like, oh no, there's a problem. They have to work it out, whether it's lawsuit, settlement, walk away, whatever. And then the last rung on the bad buy-sell agreement circle of life is the losers sue the drafting lawyer.
Yep. Okay.
So here's my best suggestion. And this is, this became a conversation piece for me on an airplane when I was sitting next to somebody on a day I felt like talking to somebody. And if they had a closely held business, I'd ask them. I'd say, well, you got one of those agreements that does something when something happens to an owner? Oh, yeah. Lawyers, got that all squared away. Okay. I said, I want you to bear with me for a minute. I said, I want you to go back to childhood. I said, remember we used to play make-believe? I want you to pretend. And I want you to pretend that a triggering event has just happened to your company. Now, then that's going to force you to pull that buy-sell agreement. And then what I want you to do is I want you to walk through what's the triggering event, what's the response to the triggering event, if there's a sale, how's it valued, who values it, how's it paid. And so I want you to walk it all the way through to closing. And Catherine, what you'll find is about 90% of the ones I see have a material defect in them. And it either pushes the timelines off because they start something like the appraiser shall provide a statement of value in 30 days. Well, I wrote a book about business valuation too, and I've been involved in more than 500 of them.
Mm-hmm.
And if your client answers all of the business appraiser's information document requests in 30 days, move your client to the front of the class.
Mm-hmm.
30 days. So then that pushes the whole agreement, and then nobody knows what the answer is. And the only people who get, rich off it are the litigators.
Mm-hmm. Yeah. So for firm, because I think for a lot of firm owners, a constant topic that I bring up to them and want them to have in the forefront of their mind is oftentimes when they look at their own financial planning situation, the business asset of the practice is by far and away the biggest thing in their portfolio, especially with some of the multipliers I've been seeing recently with some succession stuff we've been involved with. It's a lot of times it's far and away their biggest asset. And I think your point of, when people do these agreements and it just goes in the drawer, it's like, how would you feel as an advisor for a client if they did that with something that was so critical and essential and such a huge component of their net wealth? So what are some recommendations that you have besides, okay, we've got to review the agreement, really want to work through all of the different steps, really, watertight test this thing. In terms of, in my mind, I think of this as like, oh, well, we really should be having this on some kind of system where we're regularly reviewing this, like that there's some other way that it's getting pulled. Yeah. So what's the process that you recommend people get into place so that this doesn't become
let me just finish the fire drill. And I say, you work it all the way through. And then I say, the good news is this was make-believe.
Mm-hmm.
Okay, this was make-believe. But the bad news is you now know it again, and the clock is ticking, and you don't know how long it's going to be.
Yeah. Okay.
That fire drill has prompted more phone calls to lawyers. It's unreal. Okay. Mm-hmm. Here's a systematic way, and this is on my website. It's under the resources tab, and I give away my buy-sell agreement form on my website. And I have something called the buy-sell options grid. And I developed it for my practice 30 years ago. Mm-hmm. But it's a grid. It has two axes. The vertical axis are the various triggering events. And I have like maybe 18 or 20 of them. I haven't counted them in years. Okay. Obviously, most buy-sell agreements don't have more than 3 to 5, but it has all of the different choices that, I've either put in agreements or whatnot. Mm-hmm. The horizontal axis is a continuum of the responses to that triggering event. Mm-hmm. But what it does is when you put a grid on it, it gives you a one-pager where you can actually take the client's intentions. I wouldn't call it an order like at a restaurant, okay? But you can mark it in the box. Okay, what happens in death? Do y'all want to have a mandatory buy and sell, or is it going to be, cross contingent cross options? What do y'all want to do? Is it going to be a transfer to qualified, owners like children? Mm-hmm. Where it's an exception to the sale, the mandatory sale, if there's a mandatory sale at death, and they can check the box. And you know what the beauty of that is? I had clients, because I haven't practiced in almost 20 years, but I had clients who would have that attached as an exhibit to the buy-sell agreement. And everybody walked away from it. And to your point about reviews, this is what makes the review so great. Because in 3 to 5 years, I'd be on those clients it's time, and I went through several reviews with a few clients because I represented them for a long time. They would bring it with them, and they didn't read the rest of the boilerplate in that agreement, but they damn sure understood what was on that one page. It is a powerful, very, I probably, I was probably idiotic and not trying to, financially capitalize on it. but it's the best client education and information tool that I've ever developed, and honestly, one of the very best I've ever even seen.
Yeah. So we'll definitely link that in the show notes for people who are interested in it. And, because I know for when I see a lot of these situations, it's really challenging because so much of it, like having gone through this with clients for us, is having to make those decisions. And I think for a lot of advisors, like it's, if you have a junior that you're going to be transitioning to, or you have a family member who's an employee who you would be transitioning to, it's really tough to make those decisions. Are very emotional. There's the component of practicality, how things are going to flow.
Control.
There's also, who's in charge of what. And, I see a lot of times before even getting those kinds of agreements in place, like you can have a junior who has a certain understanding of how they think the transition is going to go. But because it's not in writing, it's easy to have those communication gaps, or you can have like vague language that's not specifically explaining what's going on. So that's great. We'll link definitely to that tool at the bottom. I think another component, just because I'd be remiss to not bring this up as a CPA, is, the tax element involved with a lot of this too, because I see people where they'll jump into certain structures of how they're going to exit, like in just normal exit planning. And then the same thing for like contingent planning for buy-sell agreements, without really understanding what's going to happen on the tax side. And so they can set up things to be pretty inefficient, especially if the drafting attorneys don't have a full understanding of what's going on for the tax consequences. Just a slight interruption in this conversation. I wanted to bring to your attention two things that are important for you to know. So we're always at the mercy of social media algorithms. So if you can subscribe to the show, that would mean a lot to me. Even more to me if you can leave a rating and let me know what you think about it. But we have a new newsletter that's coming out. It's going to be very active in 2025. That is specifically around tax issues that I'm seeing advisors face in their own practices, changes in legislations, and the pieces that I think are critically important for you to stay ahead of as an advisor with the new administration. So nearby, wherever you're interacting with this, will be the link of how to sign up for our newsletter. Also nearby will be the link to my LinkedIn, which is the best way to get in touch with me, learn more about what we're doing for advisors in the tax strategy and compliance work that we do, and also to get access to the various tools and interviews and things that I do, specifically designed to help you improve your practice, improve your own tax situation, etc. So let's get back to the episode, and thanks for tuning in.
Oh, you're absolutely right. Probably the most common for the people who have S corporations, which could include an LLC that opted to be taxed as an association, taxable as a corporation, and then made a valid S election. Mm-hmm. So LLC. Now those operating agreements are also almost always screwed up.
Yep.
Because they use the LLC version instead of the corporate version, and they have two classes of stock, and then they got to go get an inadvertent termination rule.
Yeah, it's not good.
but for S corps that are cash basis taxpayers, okay, if there is a redemption and there's insurance, okay, what happens? The death, it's going to be about a week or so before the funeral home gets you a certified copy of the death certificate, which the life insurance company is going to need before they make payment. Mm-hmm. When the money comes in S, if you haven't done the redemption yet, you end up with the decedent's shares that are going to be redeemed, which have already received a new 1014 fair market value basis at death, getting extra basis. It's called the wasted basis problem. Mm-hmm. And a very simple solution. You do a death redemption for a cash basis S for a short-term note. Mm-hmm. The note will be redeemed when they get the insurance proceeds, so that when the insurance proceeds come in, all of that basis goes to the continuing shareholders and not wasted to the estate of the deceased S corp shareholder. Well, there you go.
Yeah. So for people who got lost in the weeds on that one,
well, but it's really not that complicated, And I'll go back to my Central Louisiana, common sense way of saying it. do the deal before you get the cash.
Yeah. Yep. Yeah. And, I think that really highlights just that there are so many moving pieces in these transactions. And because they're so unusual for most people, you're only going to go through this experience hopefully once, once or twice.
Well,
with,
Catherine,
yeah.
and I'll tell you, I've dogged the drafting. Most of the time, the lawyers get the triggering events okay.
Mm-hmm.
It's the procedure.
Yeah.
They don't walk, like I said, they demand the appraisal 30 days, or one of the worst ones that you'll see is all of a sudden, if there's an installment payout, it's payable over 60 months at the,
Mm-hmm.
Amortized P&I over 60 months at the AFR. Well, does the company have available cash to do that? Has anybody checked?
Yeah. Yeah.
That is a very, very common, and it's also, unfortunately, because I've been out for almost 30 years on buy-sell agreements, I get occasionally consulted by E&O carriers.
Mm-hmm.
So I see some of the words. Now, bring your checkbook to the settlement conference.
Yeah. Yeah.
The standard of practice.
Yeah. And I guess one other, so for maybe more practical steps for advisors, say you've had a buy-sell agreement done and it's hard for you to self-judge whether or not that has been done correctly. What are some red flags that they should be looking out for with, was this done correctly? Do I, what depth of things do we need to go into? How often should I be reviewing this? Like, what are the red flags for somebody who's in the owner's seat to know that they need to take action here?
Oh, I think the biggest thing is to put yourself through your own fire drill.
Mm-hmm.
Pull your buy-sell agreement out. Say, okay, it's my partner's divorce or my partner's death, whatever it is. And then go into the agreement and say, okay, well, what exactly happens?
Mm-hmm.
Is there a mandatory buy and sell, or is there only a put or a call? And then if there's going to be a sale, who values it? How's it valued? Does the agreement speak to that? Mm-hmm. And then if there's consideration, does it have to be all cash? Can it be, in security, in installments, all these things? And walk yourself all the way through the closing. And I'm going to tell you that, unfortunately, now I don't think it's as high as 90%. I think that's biased somewhat upward. But I wouldn't be surprised if half. And the reason why, and I was blessed because I was both a corporate and an estate planning lawyer, because there was only 4 or 5 of us at any given time in the firm. Mm-hmm. Of a 30-person firm that, we were it for tax or corporate. So, I worked on public offerings and, I got to draft a lot of buy-sell agreements. In big firms, if you're in estate planning, you normally don't get to draft the buy-sell agreement. Mm-hmm. The corporate people do, who have no knowledge of the family issues that are involved in these things.
Absolutely.
So you end up with people who do not have the entire picture. And I'm mm-hmm. blessed that I was able to have had that experience.
Yeah, no, and it, especially for the closely helds, it makes a huge difference, because I've seen this fall, especially with like family controlled entities, which is really common. Like I see this with a lot of advisor practices where it'll be a parent and a child, or a parent and multiple children, and just getting those succession plans in place. And where, especially a lot of times with the parent who's running the practice, there's no, the exit plan is a triggering event. Like that's how they're going to be exiting out of the practice. It's going to be a health issue, or like they just physically can't do it anymore. It's very common. What I see is that it is going to be the triggering event that's the succession plan. And so I think that's great advice with the go through the fire drill, take the document out.
It's easy. It's otherwise you'll be paralyzed by what I call the parade of horribles in your mind. You imagine everything is too bad to face. Put that aside. Pull your agreement out and do the fire drill. I'm telling you, it's very effective. People have been using this for 25 years. I've inadvertently tricked them into it, but it bothered them enough to go pull that buy-sell agreement out of their drawer and read it.
Yeah, no, that's great. And I think, probably for the last component, just since it's not in most buy sell agreements, when you're doing that fire drill of just like even thinking through like, okay, which bank accounts are going what, right? Like which dollar is going where, and who's going to have projections done, and who's going to have to make estimated payments, and all of like really,
Catherine, a lot
yeah,
of sell agreements that involve flow through entities have minimum distribution requirements built
yeah,
in there.
yeah,
Because
and
otherwise you're getting phantom income on a K1 without
mhm.
cash to pay the tax. And that's the worst kind of income to get.
Yeah, so exactly. Like that's a huge component of it too, because I've seen that happen where people will get the phantom K1 income, but then the entity doesn't have cash to pay it out, or it is just, not going, whatever, like it's not there.
Get mad and they transfer the stock to something that invalidates the S election.
Yep. It goes all over the place.
Turnip truck yesterday. I've seen this game played to the hilt.
Yeah, that's great. Well, so any final thoughts that you have for the advisors tuning in?
Other than to go to my website, and there's some buy sell checklists and other things in there as well. Mm-hmm. But I'm telling you that buy sell options grid and the fire drill will generate client interest. So mm-hmm. I guarantee it, because a lot of people have done that.
Yeah, and do it for yourself, take yourself through that process. And then now this can be another way for you to add value for your closely held business clients of, you're not giving legal advice, but it's just, hey, I can read a checklist and I can take a look at it. And if it's, did you think about this? Maybe this warrants a bigger conversation.
And you will be doing your client and yourself an immeasurably valuable service.
Yeah.
Because their lawyers obviously not paying attention to it. And if you truly care about your client and you want to be your client's most trusted advisor, then those people have the courage to push the issue.
Yeah, absolutely. Well, and a part of it too is, I think for a lot of people with their attorneys, they don't have a yearly touch. Like they don't know what's going on.
The CPA vis-a-vis a lawyer, CPA's relationship is always much closer. Catherine, and I'm the son of a CPA, okay? And my father was the chairman of the state board of CPAs of Louisiana for 10 years and had been on that board for 20 years. Barry Melanson, who just retired at AICPA, got me to speak when he was executive director of LCPA to the 1993 LCPA tax conference in New Orleans. I've known Barry Melanson. He's a homeboy done good.
That's great. So for advisors listening, we'll link Paul's website, which you can check out all those free resources he's put up on there and different books that he's written, et cetera. I'm always interested to hear your feedback on an episode. So shoot me a message on LinkedIn if you have thoughts about it. And Paul, I just want to thank you again for joining on the show. This was a great episode. And for those of you listening, thanks for joining us on the Financial Advisors Want to Know podcast.